presume that the changes in demand will also likely affect the valuation of this equity position in the secondary markets as well, right? Because if I have $1 million and I'm looking to, let's say, get out, what are the am I going to get out at a discount, or am I going to get out at the full amount that I let's say invested? Like, how would it work, or what are some of the factors that would affect the valuation of this equity interest?
Well, it's a great question, right? Maybe I'll just start off a little bit. I'll hand it to you, Jackson. Because I think one key thing is, like, to get your money back means retrieving your basis. Now, the valuation of the underlying real estate might have moved massively over those years, right? You might have put 100,000 in. Like, if you did a deal in the mid 90s, you put 100,000 in, it might be worth 2 million now. Just getting your basis back is actually a massive loss to you, you know? So it links back to the real estate, and then trying to understand within that specific asset class and market and these kind of things, what it is you actually own. And Jackson, I'll hand it to you.
Yeah, it also goes back to the documentation of the deal, right? Like, if there's certain rights that the limited partner has, and therefore that if, you know, the more rights the limited partner has in the deal, the more value that the position will be worth. If it's a very restrictive deal and this limited partnership position basically just has to sit there and take whatever the GP hands out, well, then it's going to be worth less. And that doesn't just go to the economic rights, but the rights to affect major decisions, the rights to, you know, the mechanisms that are contemplated inside those partnership documents will affect the valuation of each position very differently, right? If there's basically a mechanism inside of a partnership position that makes that limited partnership position very rigid, then it's going to be worth less than one that has more flexibility and has more rights to affect change at the asset level or at the operational level. So, you know, and the devil's in the details. I mean, you have to read through all of these partnership agreements, and we do that when we need to, but mostly it comes speaking with the LP and speaking with the GP, double checking the documents. You know, we're not lawyers, and just making sure that we understand what these different mechanisms inside this deal are, and you gotta be straightforward with that. They have to be straightforward to us, and then to the investor, we have to be straightforward to them. Like, you know, these are the opportunities of this position, and these are the pitfalls of this position. You need to make a decision whether you're comfortable with it, right? And so the valuation, something could be worth zero to somebody else, and could be worth $1 million to somebody else who's comfortable with that particular mechanism of that deal.
But I think that's such a good point, right? Because inherently, valuations is a very theoretical exercise, and what we're after isn't a theoretical value. We're after an executable price, right? So it links back more to demand, as Jackson says. Like, are there things that make it more and less attractive to another investor, rather than necessarily, like, is there a model that better values this stake?